Hello and welcome to the Genuine Learning Blog. My name is Melissa Galasso, and today we're going to talk about a topic near and dear to my heart, which is government grants. However, normally when we talk about government grants, I talk about grant accounting under 958 for nonprofits. Today, it's going to be a little different. Today, we're going to look at a proposal that the FASB has put out there to change the accounting for grants for-profit entities or business entities. And this really became a really important conversation during COVID. Prior to COVID, we may have had government grants. They weren't rare, but they weren't to the same extent that we saw in the volume of transactions and the number of entities receiving them. And all of a sudden kind of put a spotlight on a hole in GAAP where we really didn't have any on-point guidance. And so the FASB over the last few years has been working on various projects, some related to disclosures, which they issued, others related to this project, which is recognition and measurement, to help fill in the gap in GAAP. Hopefully you enjoyed that. So this was actually proposed back in November of 2024. Lots of flurry at the end of the year of various exposure drafts. So we're just getting to this one, but we still have a good amount of time before the comment period ends. And this is going to update topic 832, which is our government grants topic, which came out as a result of a November 2021 ASU, which was focused on disclosures about government grants. And so while it didn't provide recognition or measurement, it did try to provide transparency through disclosure requirements. So in November, the FASB put out this proposal to really address the issue around the lack of authoritative guidance about recognition, measurement, presentation of a grant by a business entity that was received from a government, right? So government grant is really important here. This was at the top of the list in the 2021 FASB invitation to comment for their agenda consultation. People said, we really like you to fill in this gap because when we look at this, it was really for for-profit entities, they were having to analogize, right? So since there was nothing on point, they had two different options that they could work with. So when we think about the codification, we have 958-605, which is for our contributions received for our not-for-profit organizations. And that actually was just updated prior to COVID. So in 2018, ASU 2018-08 came out and helped not-for-profits, but there was a little bit of a catch, which again, I don't think back in 2018, we kind of predicted a global pandemic. But 958-605-15-6 is a scoping area, and it explicitly says that 958-605 does not apply to transfers of assets from government entities to business entities. So nonprofits have great GAAP related to contribution accounting, but for-profit entities were explicitly scoped out of using 958. So there was no on-point guidance in GAAP. Excuse me. And then their alternative is if they couldn't use 958-605, they could look elsewhere. And one area they could go to was the government assistance guidance in IAS 20. And that would be leaving US GAAP for international GAAP. And so basically they had two options and both would be through analogy since they weren't explicitly using IAS and they were explicitly scoped out of 958-605. And so as a result, the FASB is trying to address this issue that we've had in practice, which is a lack of, explicit guidance for-profit entities. So this is going to only address those entities, however. So it's really important here that when we look at this, this only applies to business entities. It scopes out explicitly nonprofits and EBPs. They already have guidance. We're not messing with them. 958-605 will continue. 2018-08 worked well during COVID for nonprofits. They had explicit guidance. They already had really good disclosures. And so we're not making any changes to the nonprofit guidance. What we're doing is filling in that gap for the for-profit entities. In addition, they do narrow it down. It does not apply to exchange transactions. Those are already in the scope of topic 606, and they are going to follow that, or potentially topic 610 if it's not related to revenue from contract with customer, and instead is a gain or loss on recognition or derecognition of non-financial assets. It also is not going to cover income taxes. So those are going to be subject to topic 740. So if the transaction's an income tax benefit, then you're going to stay under topic 740. And they're also not going to include government guarantees or below market interest rate loans. So there is a little bit of scoping that we have to pay attention to. So the first thing that we have to understand is what is the definition that we're working here with? And so the definition of a government grant is a transfer of a monetary asset or a tangible non-monetary asset other than an exchange transaction from a government to a business entity. So when we think about this, when they explicitly talk about a transfer of tangible non-monetary assets. Intangibles are not in scope. This has brought a little bit of conversation about, well, what if you get a contribution or a grant for software? Software obviously is an intangible, not technically in the scope of the standard because it's not a monetary asset and it's not a tangible non-monetary asset. So they do address that in the basis for conclusions, basically saying it's really hard to look at the variety of topics that would be in there for those intangibles. So a monetary asset or a tangible non-monetary asset, again, other than in an exchange transaction. So what do we mean when we use the word government? So again, this also had to be clarified because if you think about governments overseas, they don't always look and feel the same as ours. And so a government grant includes grants that are administered by domestic, foreign, local, city, town, county, municipal, regional, state, provincial, and territorial, and then national or federal government and entities related to those governments. So it's a pretty broad understanding of the definition of what is a government. And it talks about the fact that it includes departments and agencies and boards and commissions. However, where I find there's a little bit of confusing language here, it goes on to say that a government grant can also be, and they again use this word, administered by intergovernmental organizations and other types of organizations such as non-governmental organizations or government-sponsored enterprises that have authority from a government to administer grants on its behalf. I find this a little bit confusing. I'm assuming they're talking about pass-through grants, in my opinion. I think this is when the federal government gives money maybe to a nonprofit who then gives money to a for-profit. How does that, that still is really governmental money. If you were to think about pass-through guidance for single audit purposes, that is how it works. It stays federal money regardless of how many entities it passes through. But the word administered by does put me for a little bit of like, okay, well, what do we mean by administered by? But again, this is not a final document. It is an exposure document. It's here to help us understand what exactly the FASB is looking for, and they are looking for feedback. So they're trying to say, this is what our idea is, and do you have any possible solutions, changes that need to be made? There are two types of grants that they focus on in here. And so we have our grant related to an asset and grant related to income, because as we said earlier, it could be a monetary or a tangible non-monetary. So when we talk about a grant related to an asset, that is a government grant in which the primary condition is for an entity to purchase, construct, or otherwise acquire a long-term asset, including the direct grant of a tangible non-monetary asset. So basically, if they give you a building, right, that would be a direct grant. Or if they give you money to buy a building, right, that also would be a grant related to an asset. So while you did get income, it was specifically for the use of purchasing or building a building. In that scenario, there could be certain conditions that are attached to it, but it's still going to be a grant related to an asset. On the other hand, grant related to income is everything that's not related to buying or acquiring an asset. So again, they're trying to differentiate between the two. We will get different recognition guidance. All right, so let's talk about what the recognition guidance is. So a government grant shall be recognized when it is probable that both of the following criteria apply. One, the entity will comply with the conditions attached to the grant, right? So very often it has to be spent on a certain thing, right? We talk about allowable costs, or it has to be used for a particular purchase, right? So again, these conditions that are in there. I find it interesting that we're bringing back probability accounting. Prior to ASU 2018-08, we had probability accounting for nonprofits, and 2018-08 rid us of the probability assessment. So this would be a difference between for-profit and nonprofit. 958-605 says you actually have to, overcome the barriers before you can actually recognize it. Here, if you believe it's probable that you're going to comply and probable that the grant will be received, then you can actually recognize it. As a result, we're going to get to in a few slides, there's going to be guidance on repayment if you don't comply or if there are other potential issues that happen where you don't meet the conditions. And we saw this a lot with, think, employee retention credits, PPP loans, right? So there's lots of things that can be happening here. As a result, obviously, receipt of the grant itself is not conclusive evidence that the conditions attached have been or will be fulfilled, right? They give money up front, and then they have these conditions that you do have to meet. And if you don't meet them, you do have to give the money back. So just because you receive the money, that's not conclusive for recognition. You could have to defer that recognition until it does become probable that you have a plan that's going to meet the requirements for those conditions. Forgivable loans, right? PPP loans, right? You technically took out a loan, but if you met certain conditions, they would forgive it. So this is a loan for which the lender, a government, agrees to waive repayment under certain prescribed conditions. And so in this scenario, while it is a loan, it would actually fall under the concept, under the accounting as a government grant when it is probable that the entity will meet the criteria for grant recognition, right? So that they're going to receive it and they're going to meet the criteria and the conditions, including meeting the terms for forgiveness for the loan. So even though it's loan, it still would fall under the grant accounting guidance. All right, so let's talk about our grants related to income. So these are, again, going to be those items that are not for the purchase of an asset. And these are going to be recognized in earnings on a systematic and rational basis over the periods in which the entity recognizes as expenses the related costs for which the grant is intended to compensate. So maybe you're getting funding to cover payroll or to cover certain purchases. In that scenario, you would recognize it systematically and rationally. So again, if you have like a cost reimbursement type of contract, so this is going to be in here. Now, they don't use the term matching. A lot of people ask me questions about that. But specifically here, when we think about it, this can be a really interesting recognition. So it's recognized on a systematic and rational basis over the period in which they're incurring the related cost for this grant. For grants that are related to assets, we actually have two options for accounting. So instead of having one prescribed method, they actually give two different methods. One, which you would separately recognize the grant as deferred income on the balance sheet, which is called the deferred income approach. Or you can actually offset the carrying amount of the asset on the balance sheet, which we're going to call the cost accumulation approach. Two different approaches, two different accounting. So if you're using the deferred income approach, in this scenario, a government grant of a tangible monetary asset would be recognized at fair value, right? So in this scenario, you would put the asset on the books at its fair value, and then you would recognize in earnings on a systematic and rational basis over the periods in which they recognize those related expenses for which you're going to. And so this could, again, be related to the asset for depreciation, gain or loss in sale, impairment, etc. So it's going to, you recognize that building, and then you put it on the books and you recognize the income. On the other hand, if you do the cost accumulation approach, your government grant is going to actually be recognized at the cost to the entity. So you're basically going to say, okay, how much, if I bought a $2 million building, but I bought it with $1 million worth of federal funding, how is that going to play out? The interesting part is there's no subsequent recognition because it's already reflected in the carrying amount, right? It reflects the government proceeds in there. It's already offsetting your carrying amount. So you already get less depreciation. You already get, different subsequent accounting. So the huge difference between fair value and cost, and then parking it on the balance sheet versus, recognize it over a period of time. So really interesting that they would offer this because as a user, you get two very different outcomes given the two different approaches here. Now, as I said, because there is a probability assessment, it is possible that you thought you were going to meet these conditions and you ultimately did not. And then that grant becomes repayable, where you have to pay back the funding. And that would be accounted for as a change in estimate. And under topic 250, any repayment of the grant related to income would obviously first go against any unamortized deferred credit that you have. And then if you don't have any, or you never had any, or you only had a little bit left, you would recognize the rest into earnings. On the other hand, it depends on what you did for the grant related to an asset. If it's already in the offset of the asset valuation, you would obviously bring the asset valuation back up to show that you did not get that offset to the asset valuation. If you use the deferred income approach in that scenario, you would obviously reduce the deferred income balance by the amount that is repayable. Now, you would have a big depreciation adjustment there because obviously the offset would no longer be. So again, this is going to be an interesting one when we look at repayment issues due to the probability assessment. All right, so there's a lot in here that I think there's a lot that you can comment on, whether you like it or don't like it. You like optionality, you don't like optionality, you're not exactly sure about certain terminology. The FASB really does want to hear from you. This is an area that we want to get right. It's all new, and we want to make sure it's really good. So definitely something that you want to participate in. We'd love to hear your thoughts. Comments are due March 31st of 2025. So you have a little bit of time to get that together and make a response. All right, this is a little bit longer than normal, but it was a fun one. We didn't go over presentation disclosure that is included in the exposure draft, but I wanted to hit on really the recognition, measurement, and then the subsequent measurement guidance. But take a look if this is something that's of interest to you. With that, I want to thank you for joining me today on the Genuine Learning blog, and I hope to see you on a future blog. Have a great day, guys. Bye-bye.